Let's get into some trends today. Some of the things that we're going to be showcasing today are good indicators for you to watch and also pay very close attention to, especially in 2024, as you kind of develop your strategy. So we'll break it all down for you. My name is Paul Barron. Welcome back into TechPath. If you're brand new to the show, first thing is subscribe. It's one of the things you can do to kind of help our channel, but also your own self. And that is subscribe to this show. You'll be able to get more of our videos and others like them in your feed. So do that if you can. It does help the channel. Let's go over to Coinbase first and talk a little bit about the stock market, because this is really all-time highs. What we've seen in the last 2 months is really better performing the entire last year. So this is the big issues. However, consumers have a lot more debt. Rates remain somewhat elevated right now, and also a soft landing is still seeming somewhat difficult for the Fed, even though I am kind of leaning in that maybe they have somehow, luckily, position themselves into this kind of the concept of the Goldilocks scenario. I'll explain that in a minute. But there's some other things happening within the market. And of course, if you guys have been watching the traditional markets, you'll know that FedEx came in on their earnings very light. And that, of course, caused a little bit of panic in Wall Street. And here's the reason why. FedEx, usually a staple in terms of good earnings, did not perform. Stock took a hit almost 10%. But that's not the real story here. The real story is what's going to happen in January. January is earnings seasons, and January 12th is a big earnings season date because it's almost all the major banks will be reporting at that time. So you need to pay attention to all of that. So Q2 profits expectations are slowing in volumes, their largest division ever. Their outlooks lacks visibility. This is basically people saying they don't have a plan to fix this, because why can't they fix this? This is getting back into the whole point of people spending less money. We'll talk about credit and what kind of impact that has had on the American consumer, which all, remember, FedEx relates to shipments, shipments relate to sales. And when you see the core product being FedEx, UPS, starting to take a hit, you have to start paying attention in a big way. Other things that are kind of going with this is this whole theory around depression that is hitting the American consumer. There's an article on this. I'll show you this in a second, but they were referencing this TikTok video right here. Let me play this for you, because if you've ever bought a home, you'll get with this real quick. Listen
in a silent depression. When you compare the Great Depression to today, this is going to absolutely blow your mind. In 1930, during the Great Depression, the average home in America was $3,900. The average car was $600, and the average monthly rent was $18 or $216 a year, and the average salary was $1,300 for the year. Fast forward to today, it is $436,000 for the average home, 48 grand for the average car, and the average rent is $2,000 a month or $24,000 a year, and we have a $56,000 income for the average American right now. So if you look back to the Great Depression, the house was only 3 times the average salary. Now it is 8 times the average salary. The car was 46% of the salary. The car today is 85% of the salary. And here's the craziest part. The rent was 16% of the average salary. It is now 42% of the average salary. We are in a...
All right, so a couple of things within that, and the article kind of hits it on the head. Is the U.S. in a silent depression? They kind of look about this whole TikTok theory, but a lot of it is built around this. Some of the things they're hitting on is key expenses, obviously rising. But I think the factor that is playing into this more so is the concept of whether it's inflation versus the devaluation of money. That's the real question here. This is not about inflation, but how much we have devalued the U.S. currency. And that, to me, is why you guys are here today, because the likelihood is when you are seeing a devalued currency, the only other alternative is looking at some of these alternative assets, risk assets, much like what we've been talking about here in terms of crypto. Other things they're hitting on in the article, significant decline in economic activity spreading across the economy. Obviously, you can see this coming across on the charts here. Also, a depression, total different order of magnitude, but mainly what they're talking about here is that this is all blending into the theme around consumers. Now, remember, consumers have also been spending at pretty much breakneck speed since COVID. Also, central bank signal that it's latest that it's going to cut interest rates in 2024. I think that we're going to see, if we do see an interest rate cut, The real question is whether or not we start to get this economy in a bad position and we actually have to have stimmy checks coming in. And what I mean by that is, will the Fed actually go into printing more money? Because remember, devaluation of currency is really the theme that we need to pay attention to for sure. Another thing I want to hit on right now is that buy now, pay later stock. This is Affirm. Look at the chart right there. You can kind of see it. Here's something very interesting about Affirm. Affirm is the last stop on the credit depot. What I mean by that, premium credit cards maxed out. Secondary, subprime credit cards maxed out. Then you start to see lower and slowing credit acquisition. The next stop are payday loans and things like this, which is Affirm, buy now, pay later. If this stock is climbing, it tells us that the consumer is in that last cycle of credit. The next stop is they don't buy. And that is where you see a massive, real direct hit on not only inflation, but also a lot of these earnings. So when you start to put the puzzle together, you see the earnings already showing up on FedEx. You'll see more earnings showing up in January. And I think the retail spending data is going to be a critical one. This will all lead into jobs coming in the Q1 for sure. All right, so this is, I know it's not all it's not all bad news. There are some opportunities here. But here was Peter St. Onge. He's been on our show before, and he talks about the Federal Reserve, basically the dot plot, saying that this is where all the members come in and say, let me zoom up on that for you guys so you can read a little bit more, because they went dovish. This is what we showed earlier last week on the FOMC meeting. If you didn't get a chance to watch that, go back and watch that video, because that video is the very reason we're seeing the markets in the state they're in right now. S&P up to an all-time high, and also the crypto markets. Bitcoin, of course, cutting in over 44K. Solana, I think, over 80 now. A lot of these markets are starting to come in. So we are getting this FOMO issue of people moving off the sidelines, because remember, we're going to probably see declining rates under 5%. If we see declining rates under 5% in these money markets, then boom, you've got an opportunity. And of course, what he's talking about here is Bloomberg was giddy around this, talking about a monetary pivot of 2024. Mike Alfred, which I've talked to about on Twitter before, ventured that Janet Yellen and the big guy himself may have intervened, basically saying the White House said, lighten up, we're in an election year and we're crushing the consumer. Why did marketers go wild? Because despite ongoing inflation, Jerome basically came in and said, hey, green light, man, speculative mania, welcome to the game. All of this is happening right now. Problem is given that inflation is nowhere licked. And this is the problem I think that we do fall into. Credit is at its max. Jobs are starting to slow in a big way. Now earnings are coming in light. And you've got basically Wall Street on the upside. This is where it's a problem of the rich getting richer, and a lot of people who are trying to make it are really struggling. So I think these are the opportunities at this point, either that you're starting to look at alternative assets or other ways, or you're going to be dealing with a very rough 2024. In other words, a lot of people may end up seeing a lot more job loss and a lot more pressure on the economy in 2024. Now, how does that relate to assets? Most likely it's going to cause assets to recoil, and it could be the scenario where we do get a major rejection in the market and a correction overall. That's, I think, going to be the big question. And don't forget, everything's not completely in on a Bitcoin ETF. If it does not happen, if we do truly get a denial, imagine what that's going to do to the markets as well. So you just have to be aware of this. And I've talked about this for a couple of weeks now, is to really be presenting yourself as a caution, but at the same time, somewhat optimistic. That's the way we're looking at it. Galaxy Digital basically came in and said spot Bitcoin ETF will be approved before January 10th. I hope these guys are right, because there's a lot of pros that are calling for this as pretty much a slam dunk. If they are, then the writing was correct, but I'm always worried about that one opportunity here. Now, granted, we did a video yesterday where BlackRock did an adjustment. Go watch that video, because BlackRock did an adjustment in their filing. I think that was the biggest and most critical move for a good outcome of an ETF being approved. However, it also gave the SEC the ability to say they're controlling the AML and the money laundering issues that could occur with the bad guys coming into ETFs as well. So I think this all plays into both hands, both sides, because at the end of the day, saving face for the SEC, but also not pissing off Wall Street is a very critical issue. Eric Balchunas kind of hit on it right here. Interesting detail. SEC was worried about money laundering, in-kind creations on spot. This is what I'm talking about. This is why they dug in so much on the cash deal. But Gasparino talked about this, and I tweeted about this morning, and I kind of added some stuff to this. But he believes that the SEC is going to rule, obviously, around January 8th or after. They feel confident the SEC will approve. But unlike normal ETFs, you can only purchase shares with cash. And the SEC is worried about ETFs being used as a vehicle for money laundering. So there you have it. Now we're talking about a little bit different of a financial instrument. The question is, does it really have a big impact on Bitcoin? If it is structured this way, do we see the OGs and people who truly are trying to get curious into alternative assets? Remember, all the pressure coming from the markets right now on consumers. Are they willing to go into a low-performing ETF, or are they willing to maybe risk it a little further into some of these other assets? That's the question mark that's going to be going forward. Because of that, Fidelity came in with their Is the Bear Market Over report, 5 things to watch in 2024. A couple I'll highlight. Kuiper says basically change in interest rates and central bank liquidity could be a big driver for crypto performance. Also, the research shows digital assets have so far been highly correlated to measures of liquidity and money creation. Totally agree. And they're continuing to watch the interest rates. I agree. But I think interest rates, remember the EU just came in with softer inflation in a big way, and EU has now started to pivot already. So that's another factor that plays into this. Further in the report right here, first, it remains to be seen whether the SEC will approve crypto on the ETPs. Second, it's also far from certain whether the spot ETPs will be widespread adoption. That's the real question, is whether or not we see adoption in a lot of these products around ETFs. Another common complaint about Ethereum is that fees are high. This is another issue that I think when we see new people coming in and they see these extreme high fees, it sours them very quickly on the market, whether it's NFTs, gaming, etc., which we need to be able to migrate new investors into the market. And if your fees are high, that's another problem. Improvements in blockchain infrastructure mean that they're likely not to have bottlenecks and congestion. This has been kind of actually a counterpart to what's actually going on right now after the situation that happened with Avalanche. If you didn't watch that video, go back and watch that video. We break down all the gas fees, Polygon, Avalanche, Ethereum, all extremely high because of some scenarios around inscriptions. So, and if this is brand new, and then we're probably talking about a lot of interesting things that maybe you don't know about, go back into our channel, start to learn a bit more about that, because it's going to help you at least getting into the model. Otherwise, say with Bitcoin and Ethereum on spots, it's kind of the easiest model to take. Further into it, let's go over to some other things, because there was another tweet I wanted to showcase here. Also, this came in from Warren Davidson, which, by the way, we're going to try to get Rep. Warren on the channel. But anyone attacking self-custody opposes individual freemen. Someone wants to control your assets on their behalf. You know, this is the Keep Your Coins KYC Act to protect self-custody. This is a big deal, because remember the last time that we saw a security asset that was withheld from the American people was I think it was 1933, when basically the U.S. government says you can't hold physical gold. And they only passed it and enabled it with a license. Imagine that if you had to hold a license just to hold crypto or an NFT, digital asset. So safeguarding against CBDC or a default third-party custodians like FTX or BlockFi, that's the problem. That's why self-custody and DeFi are really an innovation you can't argue with. And I think some people like Warren Davidson are getting it. Further into this, I want to go into some predictions here by Bitwise. Bitcoin is going to trade over 80K. I'm kind of on the fence on this for 2024. I do think we'll see an all-time high, but that would definitely hit it because it was 69K on the last run. Coinbase revenue will double. Totally agree. I think Coinbase is going to be a winner here, mainly because if they can get competitive in the fee structure against ETFs, they will win because of the alternative asset array that they offer. More money will settle into stablecoins than using Visa. That's going to be a big one. JP Morgan will tokenize funds and launch it on chain. Already been done, but definitely going faster. Ethereum revenue will more than double. If that does happen, they're going to have to keep fees low. And then, of course, if we get a Taylor Swift NFT, I mean, let's just say, guys, the game is over, because if that occurs, we will see every major brand, every major company, it will become mainstream and in pop culture like anything you have seen before. It will be huge. Number 10, major upgrade in Ethereum blockchain will drive the average transaction below zero point 0.1. If that occurs, that's a big outreach. I think, again, Bitwise kind of going a little bit too hard in there. 1 in 4 financial advisors will allocate crypto. I think it's going to be better than that. I think it's going to be more like 1 in 3. A couple other things. Coinbase emerged as standout performer in 2023. That's going to kind of continue on. They're just not riding the wave. They're actively shaping its future. And we've talked about this before quite a bit. Coinbase is doing more for the industry right now, I think, than anyone, especially with Binance kind of taking the secondary seat. I think they will take a secondary position overall. And then wrapping up here, Armstrong's approach is very clear, aligning political forces. He's already done that with Stand With Crypto. A lot happening there. Year comes to a close. Coinbase, I think, is going to be a successful crypto exchange, but also a harbinger of potential transformation of the financial world. That's key, because if Coinbase is and becomes the shining point of creating these new vehicles for true DeFi and or alternative asset control, digital assets, NFTs, etc., you're going to see a massive migration. They could become one of the majors and possibly lead the way for traditional banks as a model going forward. So a lot happening out there right now. All right, so the one thing in this report by Coinbase that I want to focus on is this statement right here: is the foundations of what might be entailed are already evident. Payments, gaming, social media, to crypto-specific advancements like decentralized identity, decentralized physical infrastructure networks, things of that. I think those are the ones you have to watch. And then, of course, tokenization is a very, very big use case that will start to dominate in 24. I don't think it's going to really get its steam under it, much like gaming. I still think gaming is a 25, possibly a 2026 scenario. But the ones who are ready in 2024 are the ones who are going to win big. So that's why we cover it so much here on the channel. So stick around, subscribe to the channel. If you're not in the Diamond Circle, make sure and get in now. It's one of the best places to get additional content. You can catch me out there on X, just @PaulBaron. We'll catch you next time right here on TechPath.